Hey everybody, today I'm going to be comparing ChargePoint and Wallbox so you can see what's similar and what's different between these two companies. Starting off with the stocks, we've got ChargePoint trading at $8.10 per share at a market cap of $2.87 billion. ChargePoint stock has fallen quite substantially over the past year, and you'll see a similar looking chart with Wallbox. It's trading for $3.17 per share right now at a market cap of $623 million. ChargePoint's price to sales ratio is at 5.4 right now, and price to book is 8.8. And if you look at Wallbox, you'll see these are much cheaper, with a price to sales of 3.8 and a price to book of 3.9. To find out why Wallbox is trading so much cheaper than ChargePoint is at the moment, we're going to have to take a look at each of these companies' financial statements. Looking at ChargePoint's balance sheet from their most recent annual report, you'll see they have $264.2 million of cash, whereas Wallbox only has 83.3 million euros, which is about $92 million. You'll also notice ChargePoint's total assets were just under $1.1 billion, whereas Wallbox's were at 422 million euros, or about $465 million US dollars. ChargePoint's total liabilities were at $725 million, whereas Wallbox's were at 252.8 million euros, or about $278 million US dollars. On ChargePoint's income statement, we can see their total revenues for 2022 were $468 million, which grew about 94% year over year. But their total cost of revenues was $382 million, which grew about 103% year over year, meaning their gross margins actually worsened a little bit. ChargePoint's operating expenses were really high as well, spending $195 million on research and development, $142 million on sales and marketing, and $90 million on general and administrative expenses. This gave ChargePoint an operating loss of $342 million for 2022. Moving over to Wallbox, you'll see their revenue was 144 million euros, which doubled over the past year, but just like ChargePoint, they've got a bunch of expenses as well, with 85 million euros going towards changes in inventories and raw materials and consumables used, 88.8 million euros going towards employee benefits, 91.5 million going towards other operating expenses, and 18.9 million euros going towards amortization and depreciation. All of those expenses gave Wallbox an operating loss of 139 million euros. Moving on to each of these companies' products, ChargePoint has always been known for their public Level 2 AC chargers, but they've also been getting into public DC fast chargers as well. Now, for both the AC and DC charging models, ChargePoint is simply selling the hardware. They're not collecting revenue from the sale of electricity. But the customers that buy these chargers have to pay a subscription fee in order for that charger to stay listed on the ChargePoint network and have access to ChargePoint software. But that subscription doesn't apply to another product ChargePoint sells, which is a home EV charger that they sell for $650. Moving over to Wallbox, you'll also see a lot of Level 2 AC chargers, but they're more focused on home charging rather than public charging, with their most popular model being the Pulsar Home EV Charger. But Wallbox also has the Copper SB, Commander 2, and a new one called the Orion, and these ones are more focused on public charging. Their Quasar 2 is also pretty unique since it's a bidirectional home DC charger. So if your EV has vehicle-to-grid or vehicle-to-home capabilities, the Quasar 2 might be a decent option for you. And Wallbox has also been getting into selling public DC fast chargers with their Supernova unit, with an even more powerful one called Hypernova releasing later on. So when it comes to these two companies, Wallbox is trading cheaper than ChargePoint as far as financial ratios alone are concerned, but ChargePoint is overall in a better financial position than Wallbox is. I've got a lot of other videos on EV charging stocks, so be sure to check those out, and I'll see all of you in the next video.